Okay, so I'll start with screen share and we'll dive right into today's topic. So can we all see the screen?
Yes, we can. Can we just get a
Great.
thumbs up for everybody if you can see it? All right, cool. Thank you.
All right, great. So our Equi University. So as Jeremy did so well in his elevator pitch, we are Equi, the family office for everyone. That the one-stop shop. You can get the full solution of an alternative portfolio. So we've been asked before the call a little bit of an update on the inbound AUM applications to the platform. I'll let Jeremy talk about that.
Yeah, so this is actually a real graph, and believe it or not, so this is the amount of people who have come in the door actually applying to be on Equi, and you can see that even since August, things went absolutely haywire. So we've had over $600 million in applications and literally thousands of applicants, which is crazy because a lot of you were here with us going back when there was zero, and this was just an idea. So we're very, very fortunate that we have this much demand. And, you know, really just started with everybody on the call. A number of the people here are actually going to be, are either investors in the company or they're going to be some of the investors on the Equi platform. So, you know, for the people who are here, if you know that you've been following us for a while, you want in and you're ready to go, you can feel free to just apply. I sent the form link right there. We only have 300 spots, so we have a little discretion of who we choose. For the people here, we want to be able to take care of them. That's the link if you know that this is the right thing for you. If not, we're going to be fine because we have a lot of demand, which is a great thing. So that's my little spiel.
Awesome. So we have about 1 hour of QE's worth of inbound interest. That was my little joke.
Nice job, man. Okay,
our main topic. All right, let's do the macro update. So we talked about this last month, and you know, one of the things that I mentioned was we're going to be watching closely for what's going to happen in Jackson Hole, Wyoming. For a while, you know, we've been saying that the equity markets have typically followed the Fed's balance sheet and the Fed's intervention levels into the economy with a fairly high level of degree. They follow liquidity more than they followed fundamentals. And it's interesting to see the market's reaction on the day of the Jackson Hole's commitment. So here you can actually see an intraday chart. So this is the actual day of the Jackson Hole summit. So historically, when the Fed engages in a big change of policy or directives, as they've done in 2013 when they announced taper of the QE, or when they introduce QE, they typically do it in Jackson Hole. And it's interesting. So see the market's reaction when George and Bullard and Kaplan say that taper may be needed soon. The market actually doesn't like it. And immediately Powell says that taper may be coming someday, possibly, maybe. No any commitment to any sort of real taper at that time. The market obviously loves that and goes up almost immediately. So it's almost of a microcosm of the way things have generally worked.
So Itai, if you were Jay Powell, why on earth would you be sitting here saying, let's continue indefinitely?
I don't know if he says indefinitely, but he doesn't want to commit at the time. I think that the longer this goes, and we'll talk more about it at the end of the call, the longer this goes, the fragility of the market increases too, and the market becomes more dependent on that. So the more leverage is in the system, the risks increase. And I think the Fed's in a tough spot because even if they want to end this, they don't know exactly how and how to do it in a soft landing kind of way. And that's put them in a tight spot.
Cool.
So here you can actually see the total assets of all the central banks, you know, Fed, ECB, Bank of Japan, and the Bank of China. ECB has actually been expanding quite a bit in 2021 in reaction to lockdowns in Europe and things like that, which could also explain why the euro-dollar exchange rate has been stuck for quite some time the way it has been. So to bring back that thesis of, you know, why what the Fed does, what central banks do is so important, you can see in this graph. So on one hand, we have the total balance sheet of the central banks, and then the S&P index in red. And we've covered this extensively in the past, where we did see, obviously correlation is not causation in any mean, but we've seen periods where QE does end, such as here, 2010, 2011. The market has struggled during those times. And when the balance sheet expands aggressively, that's been some of the best performing periods for the market. And this recent one is no exception. And it's been very aggressive to accommodate one of the most aggressive, or actually the most aggressive Fed balance sheet expansion ever. So I'll translate the comments the Fed made from Fed speak to English, where the Fed basically said, well, you know, we've had readings of 4.2% inflation, 3.6% inflation, and that level of inflation is a cause of concern, but that concern is not a big deal because we feel that in the long run, inflation will be anchored around 2%. We don't see that as a big deal, and 2% is important for maximum employment and price stability. A year ago, during the last Jackson Hole, we actually mentioned that, you know, the Fed has made this comment that they may accept inflation that's higher than their expectation for some time before acting as a part of a new experiment that they're doing. So it's interesting to note, obviously, that the Fed doesn't think inflation is a concern, continues with the QE, and you know, they don't think that, you know, such an aggressive expansion of the money supply may be causing inflation, which I feel is interesting. So in this graph, you see the expansion of M1. So typically we cover M2. M2 is the broader definition of the money supply. So this is includes deposits, checking accounts, and all those other things. M1 is actually a smaller definition of money supply, and it's mainly cash and short-term instruments. And it seems like there's been so much money in circulation. Here's obviously the QE era at some levels of growth, and the amount of just actual cash in circulation has exploded in recent months, which means that at least some of that money is ending up in the economy, causing some real inflation. At the same time, liquid assets have also exploded. Here you can actually see this would be closer to M2, but not really, because this is just the total saving deposits, small time deposits, money market mutual funds, and reminding you the interest rate environment is zero. So when interest rate environment is zero, nobody's really making any yield out of this cash. And we're talking about $16 trillion of liquid assets today, with a pretty large expansion due to COVID.
So the combination of this and the M1 graph, it's like, yeah, of course, if there's actually more physical dollars available that that have access to, of course, prices are going to go up.
Yeah, it does definitely make sense. So if you want to really put that in perspective, you can actually see the rate of change of liquid assets going back to 2008, and now that fluctuates back and forth. And the rate of change in the amount of liquid assets in COVID was just monstrous, was on a totally different scale than anything we've seen before. So it's not a surprise that then the S&P 500 has posted an unbelievable amount of new highs. So there's been almost 80 days throughout this year where the S&P 500, the stock market, posted a new all-time high. And now it's on track as the second most in any calendar year since 1928. You can see here in the 90s during the dot-com bubble, we did have about 80, but that was for the full year. We're in September, so we don't need to post that many more new all-time highs in order to potentially make this even the best year ever as far as the how many days are posting a new all-time high. At the same time, buybacks are back, and corporations in the zero interest rate environment with an enormous amount of cash are basically buying back their own stock, just like they did before the crisis, where they realized, oh, we actually don't have cash to weather this recession because we spent it all on buybacks. So just like that, they're back and doing the exact same thing as people were criticizing early in 2020. And this year will probably mark a new record in the amount of buybacks. So again, more potential demand for stocks to increase. So what can go wrong? We've covered a lot of all this excess liquidity. The Fed is continuing what they're doing. So I think one of the things that's important to understand is that this actually increases market fragility. And the longer this continues, those risks increase. So before we get into that, I know we covered a little bit here, so I'll make the first stop for any questions before we get into that.
Itai, is there any evidence that that we're seeing CPI slow at all?
I think we still need more data on that. It remains to be seen. I think we're seeing some slowdown, but there are alternative metrics as well that are still showing a lot of inflation. And honestly, even for myself, and I know for a lot of other people, I've been sticker shocked quite a bit over the last few months over things, all around.
Yeah, anecdotally, I can tell you we sold a 14, 15-year-old vehicle today for something that should have gone for 3 to 4 grand a few years ago, or 3 to 4 grand maybe a year ago, and it definitely got 7,400 for it. So I couldn't believe it.
And you know what was the #1 category in the CPI?
Used cars.
That's correct. So that was a good market timing there.
Don't they also though adjust the CPI if something gets too inflated? They start dropping those items.
There's what's called the substitution effect. So that's sort of cheating the way you're saying it, which basically means that imagine the price of salmon goes up 20%. So they're going to say, well, if salmon goes up 20%, we're going to take it out of the basket and we're going to replace it with tuna that only went up 4%, because a consumer, if something goes up 20%, will stop buying it and go for a substitute. So if something does go up too much, they substitute it out. So that actually reduces the real rate of CPI. So if anybody's interested to see how CPI was used based on 1990s data, or the 1990s way in which they calculated it, there's a website called Shadow Statistics or Shadow Stats, and that actually calculates it that way, which is interesting to see because they're actually showing inflation in the teens based on how the government used to calculate it in the 90s.
Cool. All right, Itai, your favorite part. Tell us about the doom and gloom. Tell us how this is all going to end up going bad.
So without going into, the really bad things, I'm going to put my bear cap for a little bit, because it's always important to think about the risks. And, this is not necessarily something we advocate, but it's always important to look at all the types of scenarios out there. So what is true is that the market is becoming significantly more concentrated than ever before, even more so than what it did during the tech bubble. So on this chart, you can see starting in 2013 is the performance of the FANGs. So this will be Facebook, Amazon, Apple, Netflix, Google, and Microsoft, compared to the performance of the S&P 500 if you exclude those stocks from the S&P 500. So those stocks have about 7x since 2013, where the S&P 500 has only done about 150%, or I would say 50. So it's pretty incredible, the performance divergence. It's also interesting to note that the central bank liquidity has been correlated even more so with the large caps than it did with the broader S&P 500. And to give you an idea of some of the concentration risks, so the S&P 500 is divided into sectors. And as an example, Google, Facebook, and Netflix share of communication services sector in the S&P is 74%. And that's 3 stocks. And that's gone up from 55% in 2018. So the market's becoming more and more and more concentrated and correlated. So if you're looking at FANGs versus the S&P's relative earnings valuation, this is interesting too. So S&P X FANGs, X forward valuation at 47, which you could argue is already fairly high, but then FANGs are well over 200, 218 at the moment, and then the broad S&P is at 68.
And Itai, just to put this into context, normal forward-looking PE ratios tend to trade what historically in a 20 to 25 band.
Yeah, they're half of that.
They're half of that. So knowing the money printing that happened, do you think we're ever going to get back to that universe?
That's a good question. That's a
Or
part
we
of
have new normal. I mean, I think this is an important thing to address.
I think there's a fair likelihood that this is the new normal, which we'll talk about in future slide, based on the experiences of what happened in Europe and Japan when they got to levels like this. So what's interesting too is that the divergence or the delta between these valuations really accelerated after 2020. So here's your COVID, rates go to zero, the amount of QE comes in, and it immediately impacts the divergence in forward valuations. So another way of looking at it is that not the entire market is participating the way the FANGs do. So you may be buying some stocks that are not this big tech stocks and you're not performing as well and you're wondering why that happens. So the liquidity is not impacting every stock equally. In this chart, you can see the percentage of companies in the S&P 500 that are above their 200-day moving average. So that's a way to basically see what's trending up and what's trending down. So imagine you're taking an average of the last 200 trading days. Each one, has a different value. And if a stock is trading above that average for today, that means generally it's trading up. So it's a very, fast and dry method of saying how many stocks are currently trending up. And that number actually went down from almost 100% to 75% at the time where the market's making a new high every day. So if the entire market was participating, you would expect this number to be close to 100 when the stock market's making a high every day. But it's obviously making a high every day because of 5 or 7 stocks, not because of the entire stock market.
Itai, if you could for a second, one of the questions came through from Mark was, what's the link between the FANGs taking off and the money printing? Can you help understand how that trickles through?
Yeah, I mean, the money printing is ending up, in the stock market generally through indexing today, right? So indexing, ETFs, Vanguards, etc. They are the premier way of allocating. So if new money comes in the door, a lot of it's going to end up in indexing strategies, and now indexing strategies now reward large stocks because they would either buy S&P, and now those stocks are already a big part of the S&P and that grows even more, or they're targeting tech or something like that. And then a lot of other stocks don't necessarily benefit from that liquidity. So not all stocks are created equal.
And so this is why companies like a Tesla see a major spike once they're included in the S&P 500, because now all of a sudden there's a mandate to purchase even more of that company.
Yeah, and it's irrelative of their earnings. It's irrelative of their fundamentals. It's irrelative of their management company. If you're included in index X and this ETF's mandate is to buy index X, you're getting allocation no matter what you're actually doing.
Cool.
Okay.
Thank you.
So let's talk a little about some other potential issues. If you're looking for reasons to potentially either buy protection or potentially take some profits, there are some clouds on the horizon. In the past, stocks tended to follow ISM manufacturing, and it's expected to reach a peak post a recession, and COVID is obviously the fastest recession in history. Almost, you can argue it's a self-inflicted recession. And then we've reached basically the peak already for the ISM, and now it's actually coming off a little bit, similar to what happened in 09 and 10. Doesn't necessarily mean that the bull market's going to stop in any way. It didn't during this period, but we did see a period of correction in 2010 when ISM actually did roll over, and it's actually expected to turn negative around October. What is interesting, that I think it's a fairly interesting thing. The end of the pandemic could actually be bearish. So, we have over 5 billion vaccination. There were 214 million cases. And at this point, global market cap is up $57 trillion during this time. You would expect markets to have suffered through this time, but it's been the best performing period. Actually, the fastest doubling of the stock market since World War II. And Wall Street is continuously discounting endless amounts of stimulus and endless amounts of government intervention. If the pandemic truly ends with no restrictions of any sort and kind, that could actually be negative for asset prices, as stimulus may dry out and there'll be a real potential taper.
So if you think that the market's going to get, let's say they end the stimulus, the market starts getting pummeled, at what point do you think Jay Powell would step in and say right back to QE, regardless of how high things are at that time?
If he even ends QE at all, that's exactly the dilemma, which puts us in this unprecedented place, because the old rules simply don't apply, because the central bankers don't necessarily behave as they should based on pre-existing rules. So you can actually see Delta eased, for example, the pressure on rates. If you remember, a few months back, we covered this point here, where we saw some correction in tech stocks and high multiple, high P ratio stocks during this period, because rates have gone up, and typically valuations are negatively correlated with interest rates. And interest rates have come down over the last couple of months as Delta has closed, the Delta variant has closed some economies around the world, and we've seen some new restrictions apply. And what's interesting here in the dark blue, it's the COVID-19 reopening versus lockdown portfolio. So reopening stocks have performed better as interest rates have gone up, and vice versa, and it's been incredibly correlated. So now, as Delta has eased some of the pressure on yields, we've seen an even higher performance in some of these tech stocks. So the question is, if the economy truly reopens in full, we're still running the same amount of stimulus, the pandemic truly ends, you could see a spike in interest rates that could compromise the stock rally. So there are also some major dislocations in the market that need some level of resolution. I think this is one of the interesting ones where, in the past, the amount of retail sales, the drive, by the way, retail sales is incredibly correlated with the stock market, because as retail sales go up, corporate profits increase, and it's a virtuous cycle. And that's been correlated with the non-farm payroll, right? So as there are more jobs available because there's more retail sales, because people are buying more stuff, the virtuous cycle continues. Then we get COVID, retail sales fall off a cliff because A, everybody lost their jobs, which you can see right there. And then B, everything is closed. So there's nothing to buy anyways. Even if you wanted to buy it, you can only buy it online. And online sales did go up during this time. What's interesting here, retail sales have made a complete new high, which matches the stock market highs, but non-farm payroll is still under the pre-pandemic level. A lot of people blame government and government stimulus and unemployment benefits, and there are a lot of job openings, but at the same time, this will rebalance at some point, because people can't spend forever if they don't have a job. And it's just an interesting dislocation that I think is a risk to asset prices. So also we have accelerating inequality that's causing social unrest over time. As a result of government intervention, fiscal and monetary stimulus, Wall Street is now 6.4x the size of Main Street, but basically measuring financial assets as a percentage of GDP. And historically, they've been a lot less between the 1950s and 2000, maybe between 2.5 and 3.5 times. Now it's 6.4. So it just means things are becoming more concentrated, and any correction will be more painful.
Do you have any idea how this graph would have looked in the late 1920s?
Yeah, and we'll cover some of that too. It's actually more similar to this.
Oh, I like it.
Yeah, it's more similar to this. So again, the Fed is arguably well behind the curve. Another interesting correlation that totally broke down recently. On one hand, on the blue, you have the Fed funds rate. Here was that attempt at normalization that miserably failed in 2020. And then the survey of small businesses, they're being asked how difficult it is for you to fill a job. And it's, typically when it's very hard to fill a job, that means the economy is hot, everybody is hiring, and there's a lot of, basically there's a lot of money going around. And the Fed responds to that by raising interest rates and reining in the economy when the economy is too hot. And right now we're seeing small businesses saying it's never been more difficult for them to fill a job. And there's job openings everywhere and massive amounts of job openings. In fact, there are more job openings right now than there are unemployed people. And at the same time, the Fed is basically committing to the zero bound for the time being. So that's another thing they haven't really done before. You can make the argument that they would be forced at some point to chase rates higher, which could be very, very problematic for asset prices. I don't think they will, but that's a potential risk. So let's talk.
Itai, before that, do you want to just take a quick second and just see if there's any questions from everybody in the audience? Guys,
Sure.
Everybody's out there. Is there any type of any things on your mind? We're getting the silent treatment today, Itai. How do we get Rob Ross engaged a little bit more? Sorry. We'll get him. We'll get him back. We'll get him back. There he is. There he is. Okay, hop into it, Itai.
I think this is actually here is one of the more interesting things out there, which also follows demographics a little bit. You know, we did talk about demographics in the past. It's not really a topic for this call, but demographics did tend to lead interest rates. In Japan was the first one with an aging demographic. I mean, their median age, I think, is close to 50. Europe is close to 42. And I think the US now is at 37 or 38 or something like that. So the Bank of Japan now has been in zero interest rate policy and even negative interest rate policy for over 20 years, right? European Central Bank has done this now for 10 years plus, and neither of them has been able to normalize their policy. And what's interesting is you would think that the zero interest rate policy would be positive for asset prices, but it wasn't in Europe and Japan because there was not enough loan demand and their economy has just been stagnating for a long period of time. Now, the US is still different. The housing market here has been sensitive to interest rate changes. We've seen a huge wave of refis coming in when, when rates dropped right now, that put more money into the economy. And we also have an enormous tech sector that is fueling the market growth and fueling almost global growth. But that tech sector is still very sensitive to interest rates. So you could still make the argument that the US is different from Japan and Europe because of those differences. Now, what's interesting in this research chart that I saw is that if you look here, the yellow line, that's the Bank of Japan rates starting in 85. That's the European Central Bank rate starting in 01, and the Fed funds rate starting in 14. So it almost seems like the Japan led Europe by about 15 years, and Europe is leading the US by about 10 years. So you can see here there some sort of bubble top in Japan, the famous 80s bubble, the tech boom or bust, I would say, in Europe causes them to lower interest rates, similar to the financial crisis in the US, that in 2014 we came from a zero rate policy. Then all of them attempt to normalize policy. The Japan did it and then caused some serious damage to their asset prices. European Central Bank did it too, and the Fed did it too, coming into 2019 and then 2020. And then they all dropped back to the zero bound very, very quickly, and they all failed to normalize. So the Bank of Japan has now been in the zero interest rate game for 26 years. And the European Central Bank is in it for now 11 years. And the Fed is now starting interest rate zero rate as of last year. And the argument remains to be seen, are we basically following that trajectory?
Yeah, so that's the question that it leads me to ask, which is, at the end of time, do we just kind of, there's never a dramatic fall off, we just kind of become Japan and it kind of stays in this zero interest rate environment basically forever? Or does this end with a cataclysmic 1920s type of crash that resets everything?
Yeah, that's a good question. And it's actually, we'll talk a little bit about that if we have the time today. But it is interesting for, it's interesting for a lot of things. You need to, especially, one of the reasons Europe has such low cap rates, a lot of it has to do with that very low interest rate policy. So the US still doesn't have that mindset of zero bound forever. And if it did, then real estate cap rates would be 2 to 3%. But we are starting to see some of that pricing happening. in some of those markets. So I think it's one of the interesting indicators to look at, because the price of money impacts everything over the long run, and that's important to follow. Okay, so inflation, as we said, could force the Fed's hand, even though we have the base effect from last year, and we have the used car sales and all that. Nonetheless, we're still at 6.8% CPI, which is crazy, because those are 1980s type numbers where the Fed funds rate was 8 to 12%, and we're nowhere near that now. So again, another very interesting observation. Also, looking at earnings per share, we have seen peak profits. So you have your trough, kind of like the 0809 trough, then you have your peak, then earnings basically fall back and then normalize, and we are seeing the peak, and global EPS is projected to decelerate quite a bit. So a lot of these things will decelerate. Maybe it will actually affect CPI, and CPI will come off and we'll go back into Goldilocks, but that remains to be seen.
A.K.A, could you explain that last chart just a little bit more, just what the difference is?
Yeah, sure. So basically, this is just the projection of earnings per share growth, and earnings per share, when they grow fast, it's typically bullish for stocks. And we're seeing right now that the EPS model is projecting deceleration. So the level of growth in earnings is not going to be as intense as it was in the last 2 quarters, and earnings are already, or valuations are already very, very high. So you need earnings to grow quite a bit to grow into those valuations. So it does pose a risk where earnings could decelerate when you have high valuations.
So is this, or is basically the global EPS and the Bank of America global, that you're just using two different data gatherers that are in agreement? Is that what this is? Okay.
Yeah, so you can see that the B of A global EPS model has been tracking global EPS growth very, very accurately over the last 20 years.
Itai, one of the questions that came in is talking about the economic effect of rate cuts versus the economic effect of quantitative easing. Can you please explain that?
Sure. So and we'll actually talk more about that, and how the Fed had to use different tools, which was a part of it. But basically, you can only cut rates to a certain level. So pre-0809, QE wasn't used at all. Actually, it was used in the 1930s. But besides that, it wasn't used at all because it was enough to control the interest rate environment. So typically, when rates go lower, money is easier because loans are cheaper. And if more people borrow, it puts more money in circulation. But you reach a point where the incremental difference between 1% rate and 0% rate is just not significant enough to stimulate the economy. And as a result, the central bankers just started using quantitative easing, which is basically just printing money. And they print money with the way it's done. And we'll cover that very, very deeply in the call, but just breezing through it. They basically don't just print money and put it in the economy. What they do is that they create money out of thin air and use it to buy government securities or government bonds that are being bought from the U.S. Treasury, and then they fund the federal government's deficits.
Got it. So it is, the QE basically allows us to run the deficit game.
Because nobody wants to buy your debt when you're running zero interest rate policies, because no foreign investors or typical investors would come in, which we've seen the amount of foreign investors in US securities drop during this time. But it's more complicated than that, because foreigners will hold US securities as a way to get exposure to dollars, because dollars are the global reserve currency. So it's a pretty intricate topic. So I'm not going to go into that right now.
Cool. Keep it going.
Okay, there are also some potential better alternatives to the U.S. stock market. If you're looking at the relative prices of emerging markets versus S&P 500, we're seeing levels of EM versus U.S. stocks that are close to what it was in the 90s and 2002, before period of outperformance in EM stock relative to S&P 500.
Got it. And do you want to quickly talk about the the relationship between the dollar cycle and the emerging markets for people who don't normally get to see that?
I knew you're gonna bring it up. So when you decide to take an EM position, it's important to have a position on the direction of the US dollar as well, because a lot of EM countries take loans in dollars, and then it creates a cycle in their economy. When dollars appreciate, their debt payments become more expensive, and could be bearish for EM. But during a period of bearish dollar moves over an extended period of time, that tends to be very bullish for emerging markets, because if they take in dollar loans, then the percentage that they have to pay back declines. So that basically is bullish for EM stocks. So it's just another context point.
And what emerging markets would have been an emerging market back in 2002 that's no longer an emerging market in 2021?
That is no longer one,
Right.
Maybe South Korea.
Okay.
Okay. Another thing that's interesting, divergence between high yield and equity. In the past, such divergences could have been problematic. The most famous one, of course, is in 2007, where you actually had high yield not making a high, and the market's making a high, and eventually this was a potential warning sign. So we are seeing a pretty big divergence now between high yield markets that are not even making the high they did in 17, 18, with the stock market reaching a new high. And here we're looking at the total return stock market, not just the S&P 500.
It says high yield, high grade. I always think of high yield being like B bonds and that type of stuff, and A.
Yeah. You can look at J&K and HYG too.
Itai, Larry's got a question for you. Larry, you want to hit him with it?
Sure. So you mentioned it almost casually passing. We've discussed it in the past, when we talked about petrodollars, the probability or lack of probability, I guess, of the US dollar, losing its status as the world reserve. But what is the likelihood of that? What would it look like? And then what happens to all this?
That's the $1 trillion question.
Yeah.
It's very difficult to answer too. I think when we talked in the petrodollar one, I think it will eventually happen, but I don't think it will be as a market event. It would be a gradual thing that happens over many, many years, as just less and less people use the US dollar for trade. And then, without realizing it was it kind of just happened. I think it would be almost like a 20-year transition.
Well, okay, but I find that a lot of those things happen faster than people anticipate when and if they gather steam. But even if it's 20 years, and we're talking now about, you said, how is it you can print all this money, and who's going to possibly buy the debt? And you said, well, some of these foreign nations do in fact support our debt because they need the dollars. But if that goes away, does our whole economy crumble?
If that goes away,
or does the dollar just get so devalued as a result?
If that goes away, it would cause significantly faster dollar devaluation than, so imagine right now, if all that printing happened and the dollar wasn't the global reserve currency, you would see inflation at a far higher level, and you'd see dollar devaluation at significantly higher levels than you're seeing now. The US
Greece,
is still
like Greece and Venezuela.
Yeah, the US can get away with it because there's global demand for the dollars, and that's enforced by the US military.
Well, okay.
Or at least historically it has been.
Right. We're not doing a good job with that recently.
That is very true. Itai had another quick question come through, which is for somebody that wants to get exposure to emerging markets, what's the best way to do that?
There are easy ETFs you can buy, like EEM. There's country-specific ones too. You don't need to. You can even get fancy, and there's some currency hedged ones that you can research. But the easiest way is just EEM.
EEM?
EEM, yeah, that's the emerging market ETF.
I thought you said EDM for a second, and I'm like, Itai, what are you doing on the weekends that you're not telling us about?
EDM, what's that?
Exactly. On to the next slide. Everybody just got
Move
their
on,
laugh. Thank
move
you.
on.
Okay. Okay. So I think we won't have enough time to cover all this today, which is why I kind of knew it would be a two series call. Now we're getting deeper into our topic on QE, and basically in order to understand why QE even happened, I think it's important to understand the long and short business cycle made famously by Ray Dalio. So I'll give him credit for a lot of that. So let's talk first about the business cycle that we all know. That's the normal traditional business cycle, and why things are different now. So typically when you have an economic expansion, when it starts, businesses and people recover from whatever recession happened in the past. And when they recover, that's because rates have gone lower. Maybe QE happened. In this case, actually QE did not happen because this is a typical business cycle. Think of 80s, 90s, early 2000s. So rates go lower. It's easier to get credit. So basically people now borrow more, they take some risk, they open new businesses, things recover. The expansion continues and more level of debt come in. And then eventually you get some level of overinvestment and too much consumption. People are going to buy a house that they don't need. They're going to buy an extra car that they can't afford because there's a feeling of money going around and everybody's doing great. And then eventually the economy gets too levered, too fragile. And during this period, the asset prices just go up and away. And the main reason for cycles in general, like why cycles exist because of debt. If debt wasn't in existence, if there was never access to any type of debt, you wouldn't actually have cycles because things would just go this way, the way they have gone through the majority of human history. But the invention of debt is really interesting because it allows you to do things based on future promises of things that didn't exist yet. Think about it. That actually revolutionized human history.
It absolutely has. It's incredible.
It's incredible, but you can have too much of a good thing. So
isn't it true you pointed out before that like in 1928 or whatever, less than 2% of the people like own their homes, and then with the expansion of the ability of mortgages and debt, that is now it's like 61% or whatever it is.
I don't know if it was as low as 2%, but that definitely increased the amount of people that could afford a home for sure.
Itai, one of the questions was, I know you liked your EEM. What do you think about VWO instead?
What's like Vanguard total market?
Vanguard FTSE Emerging Markets ETF.
Yeah, I think they're very similar.
Cool.
Okay, so let's talk about how the short-term business cycle ends. So then you have some sort of negative catalyst that's combined with the high levels of debt. So the catalyst could be like a COVID event or 08, 09, or the dot-com bubble, or LTCM, or the Asian financial crisis, or the tequila crisis, or Black Monday, or whatever it is. And then when you do have high levels of debt in the economy, it triggers a shock and triggers some level of deleveraging. Like, oh, I actually don't need that second home I have in Florida, and then I'm going to sell it immediately during a recession, which, by the way, is why Florida has had a much more volatile housing market historically than a lot of other states. It goes back, more than 100 years because it's such a place of tourism and second homes. As an example. So then typically what the central banks and policymakers would do is they will then lower the interest rates and they would offer some sort of fiscal stimulus. So that would be fiscal is what the government does versus monetary, which is what the Fed does. So then when they do fiscal stimulus, they provide more unemployment checks and benefits and help to more people. And then they would basically do that as a way to offset what would otherwise be deflationary. So they're trying to put more money in the system and get the recession cycle as short as possible, because all the political incentives out there are to get this recession as short as possible and move forward. And
Right.
this is
Itai, one quick thing. I think it was all on our minds. You mentioned the tequila crisis. Did we hear that correctly?
Yeah, 1994. That's when Mexican default.
Ah, okay.
I thought that's when A.K.A. had graduated college and didn't have any money for a Friday night. Larry used to have that, but that was back in the 30s.
One day we'll do a economic crisis lesson, and we'll go over all the shocks and why they happen, if you guys want to do that. Okay, so basically normal business cycles. So the growth trend does continue in this fashion. So over time, you do see economic growth. That's benefits in human productivity over time. And then debt is why you have these cycles, because here you borrow and then things deteriorate, you have to pay it off because you borrow from your future self. And here it goes up and businesses and people borrow, it peaks out. And over time, it just looks like that cycle, and debt is what's fueling that cycle over time. So basically the policymakers' response to the recessions is they never reduce the debt. They don't want to, they don't have any incentive. So what's interesting is every time that you go through one of these cycles and the economy starts deleveraging, policymakers have reacted by lowering interest rates and putting more liquidity into the system. So even though you recover some, there's some what's called creative destruction of capitalism, and some businesses have failed and other stronger businesses swallow them up. For the next business cycle, debt levels have always been higher. And you can actually see that in this chart. So in the blue, you have the amount of liabilities or corporate debt in the system. And then in red is the federal funds rate, and starting here in the 1980s. So here's that early 90s recession. There is the leveraging, and there's also a reduction in interest rates. And then the 2000s, some deleveraging from .com, some deleveraging there. But what's interesting is with every cycle, there's a little bit more debt in the system, and rates are lower and lower and lower and lower. And at some point, they actually can't get any lower. They reach their zero bound. And then policymakers have to be more creative and do even crazier things to keep this going. So what's interesting,
Itai, if you can go back one step.
Yep.
If you went back to 1980 here, but what happens if you go back a few more decades? Is this something that, I mean, it seems like while you say interest rates can't get any lower, at some point they're not going to get any higher either. So I imagine it wasn't always this kind of slow. With each cycle.
And we are going back forward. There's a few slides going back actually to 1900s going forward.
Okay.
There was a similar event that happened in the 30s and 40s, where rates did go to the zero bound in the 1930s, and eventually things did recover post World War II. But it was actually similar because you had, I guess the point I'm trying to make is when you get to the point where you have a huge amount of debt and you're hitting the zero bound, there's not a significant marginal increase in your benefit from having lower rates, because you already have an enormous amount of debt and you're already at the zero bound. So that's usually when they realize there's two things we can do. We can either let everything crash and let this deflationary spiral happen because we have way too much debt, or we're just going to inflate it away and we're going to print a bunch of money. And if you give that option to policymakers, they want to avoid pain. They don't want to do what's hard. So they're always going to choose to print. All of human history has proven that. And then I'll just cover this slide, and I think we'll wrap it for tonight because we are approaching the hour mark, and we'll do the rest on the next call. But it is interesting that, I showed you on this chart the private debt. So this is corporate debt, right? But there's another debt type, which is the federal debt, the debt of the federal government. So what's interesting is that when the corporate debt increases and the economy is doing well, the federal debt is basically stagnating or just staying about the same because the federal government is not going to use less debt. But then when the economy goes into one of these recessionary periods, what happens is that the government has to step in, and the government has to pay unemployment benefits, and they have to spend to stimulate the economy. And at the same time, they have lower tax revenue because of the recession. So government debt goes up during recessions, especially now in 2020, it's been crazy. And what's happening is that during the good times, corporate debt goes up. During the bad times, federal debt goes up. So at some point, debt continues to go up at all times. So the total debt doesn't stop going up and up and up. And that creates a long-term debt cycle. So in the short term, you do some level of deleveraging, some businesses fail. And then what happens is that the better businesses grab them. But then over a long period of time, the debt burden just becomes so huge that you can't have that normal level of deleveraging. And that only happened twice over the last 100 and some years. It's happened in 08, 09, and now in 2020. But it's also happened in the 1930s and 40s when you're reaching that zero bound. So you can see here the total debt percentage of GDP versus rates. So here you see the short-term interest rate hit the zero bound in 1931. And the debt to GDP level was huge, and then it actually deflated away. And you've seen that here too in 08, 09, and there's some deflation, but not much. So one of the interesting things to note here is that the amount of total debt to GDP has declined, but not because there was less debt. It was because the amount of currency in circulation exploded. So here you have another view of it. You have the short-term rates, but this is the total debt as percentage of M2, money in circulation, right? Total money in circulation. So over here, we peak out and rates are at zero, and then the debt burden is diminished, not because there's less debt, but because they printed an insane amount of money. And then here too, starting in 08, 09, we hit the zero bound, and the total debt as a percentage of the money supply has started to go down, because policymakers made the decision to inflate the debt away by massively expanding the money supply. So there is a real reason for why they're doing what they're doing, because they understand that there's limits to that zero bounds and how basically QE impacts the economy. So with that said, I think we'll wrap it for tonight and continue this next time.